Good morning, all of you. Thanks for being on a Sunday. It's a great time to spend some experiences that we have garnered. It's a bumpy one that lead to get a questions on how things are looking on the market, but this is what we do. Obviously, we have seen some sort of volatility in the month of August, right? We had a very good run till the month of July. But if you really look at the numbers, say indices, if you look at the mid cap and the small cap indices, to be honest, it hasn't moved anywhere. Say Nifty Midcap 100 in this month is barely down 40 bips, right? If you see the last 2 months, they were up almost more than 10%. Similarly, it has happened for small cap, which is down 2.5%, right? But at the same time, a lot of weaker franchise speculative name has seen the burnt. Like a lot of these businesses which were grappled up by all the retail participation are down anywhere between 5% to 20%. So a clear cut thing which is happening is that people are now trying to see, it's like sanity is now prevailing and people are now focusing on quality and rather than just.
Aishwarya, you have got muted.
Someone did that. No worries. Yeah. Am I audible, Siddharth, now?
Yes. Yes.
Yeah. We have to also understand that there were a couple of events which has played out for this, which has acted as a catalyst. First, obviously, was the regulatory part from CB side where they bring a lot of tougher restrictions, which has acted as a catalyst for this kind of small cap and mid cap correction. Second was obviously the all the noise about whether US will bite the bullet and how the tapering will go, and all those came at the same time, and we saw the volatility in the mid and small cap space. Now, what is really important is how things look from here onwards, right? We are of a view that this is not like a 2017 kind of a rally. This is more like 2003 till 2008 kind of a rally. And why do we think so is that 2-3 important factors which are playing out very, very clearly. First is we all know that there is a very, very strong correlation between how a broader market works compared to how a broader economy works. There is a very strong correlation between the two, right? And we believe that we're entering into a decent GDP environment. Specifically, if you see primarily supported by obviously it's a base, but if you really look at, we're entering into 8.5 to 9.5% kind of a very, very conservative growth number for the next 2 years. If you see history doesn't repeat itself, right? But history always rhymes. Look at the last 2 decades of number of how any broader market has done compared to how the GDP growth has moved up. If you can plot that figure from 2003 till 2007, there's a beautiful graph between how the economy grew up almost 8-9% and how the performance has been for the mid and small cap. Same thing happened briefly for 2014. It happened in 2017 also when GDP grew almost 8.3%, and then we saw a good amount of rally picked up. The rally in 2017 started faltering because the GDP could not hold up. This time around, because of the base, we expect GDP to grow anywhere between 9%, 10% kind of a number on a more normal basis, and that should bode very well for the mid and small cap. Second most important thing is, if you really look at from 2013-14 onward till 2018, or even before COVID till 2019, the earning growth of the whole system was barely low single digit, 6-7%, right? You can take different data points. A lot of people tell us that market is looking very expensive now, right? Market is definitely not cheap like the way it was in March or April of 2020. But let's just look at this data point. When your earning was around 6-7%, 8% on an optimistic case between those 4-5 years, 6 years, market is to trade at something close to 15 times, 16 times, trailing price to equity. It basically means that on PAC basis, it was close to 2.5 times. FY21, your EPS growth was almost 14%, and your GDP declined by almost 7.4%. Right now, next 2 years, primarily supported by base, primarily supported by all the tax cuts and the kind of growth which economy will see. A base case number of 20% CAGR for the next 2 quarters is very much doable. I can tell you, street is at almost 30% growth for FY22. We already have seen first quarter number with a very, very strong outperformances in many sectors. So we are entering into a solid earning trajectory. It's not only about GDP growth, but it's also about earning. So we believe that one should focus on businesses which are going to sustain this kind of earning growth over the next couple of years, businesses which are going to basically benefit out of the current situation, right? We all know that economy is all not hunky-dory. Things are really tough on the ground, especially on the SME, MSME segment, the unorganized part and all that. But you're not investing into India. You're not investing into these companies. You're investing into businesses which are going to benefit out of the formalization which is happening in the country today. Businesses which have a very, very strong balance sheet, who can use it, leverage it to scale up their businesses and report high earning growth. I can tell you there's a lot of money which will be made over the next 3 to 4 years, right? It's not only about mid and small cap, it's across the segment, but it has to be on earnings, and on earnings, and businesses which have the capability to do that. Most important point before I let Siddharth add further on this, we believe that easy money is making is behind us now for sure. There I can tell you, a lot of people say that if we used to go and talk about 20%, 15% kind of a compounding, people don't get excited now. Everybody is a fund manager these days. Even the topic today is, you become your own fund manager. But I think last 1.5 year of rally, bull market doesn't teach people a lot, right? We believe it's time that sanity should prevail, right? And the portfolio should move toward businesses like this, which I was talking to you about. It should be more toward quality, right? And we have to live with that easy making money is behind us. And now since the earnings is expected to grow 20%, one should be happy to make 20% compounding. And I think Siddhartha can tell you how compounding really works. He is great at that. So in short, our view is that we are very, very positive on this. Don't get lured by what's happening around the noise. If you're into quality businesses, you should be able to sell it through. And the next 3 to 5 years looks very, very compelling. Over to you, Siddhartha.
Thanks, Aishwarya. So a couple of things, guys. First, if you are investing in small caps, you have to go through 2 cycles. Now, what does that mean? It simply means that one up cycle down and then another one. If you really want to make a CAGR, a compounding of more than 25 or 30% over the period, you have to witness 2 up cycles. History tells us, and as Aishwarya said, that history rhymes. You look at it, 2003, 2004, 2005, were extremely good years for small cap. Again, 7, 8 were very bad. 9 was relatively modest, and again it surged. Then 12, 13, 12 was a good year, 13 was a bad year, 14 was a phenomenal year, 15, 16 were bad years, 17 was a phenomenal year, 18, 19 were bad years, 20 first half was 20 was a bad year. Most people believe that the small cap rally actually has happened from 20 onwards after the COVID. No. The small cap rally started post Modi 2.0, 2.0 budget, which was on 31st of January 2021. After that, so intrinsically, only 6 months or 7 months of small cap rally one has witnessed, which means it's not the end. So that's number one. Number two, very, very distinctly, as Aishwarya said, and I'm just reiterating that fact, that Gadha or Ghoda, which essentially means anything to everything, which has been flying till now, is gonna get curtailed, not because of choice, but because of the regulation, because SEBI has said that there will be extra monitoring of all mid caps and small caps. That was the earlier announcement, and then it got clarified. Any company which has less than 1,000 crores of market cap, basically in X, Y, Z or Z plus categories, all those will only be monitored, which essentially means the bottom 1,500 companies or 5,300 companies are the ones which are going to get impacted adversely. And those were the ones which were moving by almost 150% in last six and a half months. So that's number two. Number three, clearly there are sectors in India where there hasn't been any large cap presence at all. And those sectors are essentially represented by mid and small cap companies. For example, auto ancillaries. For example, chemicals. For example, pharmaceutical specialists, not generics, not the Sun Pharmas or the Lupins of the world. There are a whole bunch of generics which are represented by mid and small. Industrials, in the homemaking, all of them are represented by small caps. Now, the interesting point is what we want to believe. Our mind is saying that COVID is out of the way, and that's why everything looks hunky-dory. No, it's not. And the first victim of it is the international trade and commerce. What does that mean? International trade and commerce, which means that companies which want to source inputs or small equipments from China, they are not able to do so. Small cap companies are acting as a replacement because they are getting hyper demand because the end product gets stuck. You all understand that small cap companies are generally in between the supply chain. They don't manufacture too many of end products. They fit in between the large suppliers and the large producers of end goods. They fit in somewhere in between. And with the disruption in the international trade continuing, with the supply chain still getting disrupted, these smaller companies are getting undue benefit. Last 18 months have been phenomenal for them. So that's on the earnings side. Second, positive on the earnings side is most of the small cap companies, not for the emerging giants which Aishvarya runs, but most of the small cap companies are highly levered, highly leveraged. And their cost of leverage is anything from 14-15% going up to 18% as well. With the interest rates lowest in the history of India, in 75 years, one has never witnessed interest rates at such low extent. That is acting as a positive catalyst because any reduction in the interest rates for a small cap company impacts the PAT directly, which means your cash EPS jumps. So that's number two. Number three, because of the COVID, most of the small cap companies have reduced their cost base. They have trimmed it efficiently, whether through digitization, whether through payment mechanism. So think about it. The person who used to always take the checks and deposit it in the bank is no more required because all the payments now happen digitally. So one person is less in the small cap company. Similarly, the costs have reduced by nearly 20 to 25% for these small cap companies, and their revenues have gone back to the level previous to COVID, which is February, January 2020. That all these three factors, earnings growth, lower interest rates, and the disruption in the global trade cycle is acting as a very, very strong positive catalyst in pushing the earnings momentum for these small cap companies. So our belief is very simple. The ride of small cap is not going to be linear. It is not going to be in line as the Nifty and Sensex 0.1, 0.2 keeps moving up and down. It will be volatile. But if you look at businesses which have higher integrity, higher ethics, higher corporate governance, and more importantly, monopoly businesses, very important, monopoly at a micro level. Now, what does this monopoly mean? Monopoly mean that monopoly at a process level, monopoly at a product level, not the entire large chemicals market, a product, or in a geography, your margins will only expand from here. And there is lots of money to be made. And you can actually see some of the small cap companies which have got listed in recent times, in last 12 months, 18 months, they have become nearly 1.5, 2x after the listing. And the reason why it has happened is because their earnings momentum continue to grow. So the point I'm trying to say is we have at least next 36 to 48 months of upside in the small cap cycle. However, one caveat, one disclaimer here, please keep in mind there will be a down cycle. Remember, if you want to make tons of money in small cap, stay put for 2 cycles, you will get surprised the kind of returns you will make. So even if there is a downturn in the small cap, stay put. Wait for the next up cycle, exit at the next up cycle. You will be blessing yourself by doing this small act, which nobody does. Nobody does, because people are in a hurry to quickly book the profits as soon as the first upcycle is over. With the second upcycle, your compounding escalates by nearly 8 to 10% over your current compounding. And you can see the difference. Try it once.
Super thought, Siddharth. So you sort of dovetailed into the next question, so I'm going to put it here. Mainak wants to know how to go about position sizing and entry and exit points on stocks. So you sort of answered the entry exit point, but of course,
so Aishwarya, let Aishwarya talk about the specific entry and exit. Then I can talk, because I'm a macro guy. We have the fund manager who can tell you exact point by point entry and exit. Aishwarya.
Yeah, so I think there were three parts to it. One obviously is position sizing and entry and exits of businesses which have been bought or invested into. Now, what I strongly believe is there is no fun if the conviction is not played properly, right? It's actually, at least we know there are like 600 companies, inclusive of large, mid, and small cap, which have some amount of credibility, which one investors can pick up. But finding those right 10 names is a daunting task. And if you have spent a lot of time and energy in identifying those 5 or 10 names, you should have them have a decent exposure, is what I'm trying to say. So even if you, just to give some example, that like to give an example, say any name, say the guy like Al-Amin, right, which we invested into. If we had not done a decent exposure to them, even if the stock went up 10 times, it will not change your life, right? So it's debatable, because we are come from a different sphere of lives, right? Someone is doing some high profile corporate job, someone has got a business to run to, right? And they have like different working capital needs or some other commitment that they have, and allocating money toward equity is like we all normally think that is the last thing to do, right? But whenever you do it and whenever you are doing with a conviction, always have a decent exposure to that particular piece. The exposure should be like that even if it goes down 40-50%, your life should not get impacted much. But if it fructify, your life should change. That is the most important. That there can't be a single number. So it depends on individual risk profiling and finances. Second question, which you talked about, entry and exit. I'm a kind of a person who find it very difficult to let go stocks, because we work with the thesis that we are not buying stocks, we buy businesses, right? We believe buying stocks, someone told someone that's like tapes and all that, is basically overrated. Wealth is not made that way, right? Wealth is made, a lot of people, if you see the last 1.5 year of rally, you might be hearing a lot of people made quick money, or a lot of them make really big money. The people who made quick money is all exciting, but the people who had really made money didn't wait. We just came into the market in the last year or so. They have been waiting for time like this for a decade or so, right? So not only have they then done the correct sizing, but their entry was like, has been there for a long time. You can't just wake up one single day and say, okay, now I will come and invest in the market because market looks good, and you will just go on. It's just not practically possible. So invest into businesses, as I said, which gives you comfort, where you really understand, where you connect with those businesses, where you have comfort on the management. We'll keep that side of selection later. But when you enter into businesses, try to do one thing, that you should try to buy growth at a reasonable valuation. Follow this simple principle, right? As an individual, it's very, very difficult to find value stocks. Stay slightly inclined to businesses which are growing, and try to see whether you're trying to buy that growth at a reasonable valuations. And once you're invested into these particular names, right, exit is very, very important, right? And exit is specifically important in the mid and small cap space, right? In large cap, until unless you have a sheer need of liquidity, right, you should try to stay with this business as long as you can, right? In mid caps, also similar. In small cap, you have to really ask yourself whether this company can become mid cap or a large cap. If that answer to that question is no, then you should spend a lot of time and energy to understand where the valuation of those businesses are. So you should follow these three simple mantra in these kind of cases. First, when you invested into a particular name, has anything changed in that business? or whether the DNA of the business has changed, which is completely different from what what it was during when you invested, during that investment thesis. If there's a big change and if that change is not comforting, exit as it is. Right. Second is when you believe that there has been some noise or something which you come across which is not comforting on the corporate governance. Anything which comes to you or notice after since you're invested, never be lethargic on that side. There is no place of hope in investments. Get out, right? Even you have to get out at 20, 30, 40, 50% lower of your cost, get out of that name. And third but not the least, specifically in small cap, it is not applicable in large and mid. In small cap, if you believe that the stock is cornered, there is a technically lower float, you believe that the valuation has completely gone, or it is trading at 4-5 times back, people are really getting excited about that name. I don't want to name a lot of businesses, but you can go to the history of the last 5 years and you will see many such instances. It's always good to book profit out of those kind of a scenario. When people start selling you hope, it's time that you move out of those names. So when everything is very hunky-dory, I think it's time to go back home. So that's only applicable in small cap. I can tell you, let me give you some example. People tell me, buy low, sell high. People follow this, buy low, sell high. Most of the B school taught us, right? Even if you go, and everybody will talk you this. This is the magic mantra, buy low, sell high. But if you really come into this business of managing money, and I've been doing it for the last 15 years, I don't understand what is low and what is high. Right? I've been looking at IT sector for 15 years now. That was the first sector which I got when I started with my fund by side role. That time, I was really surprised to see that companies with 40-50% ROE sitting on good amount of cash, right? There is no way that this company can go bankrupt, right? I understand they're not B2C, they're B2B, but they're phenomenal businesses, throwing cash. Like if you see the annual report, you can see that cash coming out of this. They used to trade at 15-20 times price to earning forward, right? And I used to ask people, then they used to tell me, TCS is a sell, it is at 19 times PE. No, it's a sell because it's expensive. 4 years down the line, TCS at 30 times has gone up 4 times since the investment. And so it's all subjective. It's buying low, sell high is all theoretical. It looks pretty good, right? We have seen it has happening pretty light. We have seen happening it in C Cements, or we have seen happening with many such examples. And a lot of people tell me, Aishwarya, why we have to always talk about success stories? There are failures, which have gone up and people have not booked money and they've gone down back. We have to really understand that they were always and always speculative names where things like this has happened. If you are very clear that you are not going to make some quick money, right? Quick money doesn't change life, right? If you're staying away from quick money, if you're bound to invest into businesses and not stock, you will have no reason for them stock to come out or basically to sell until unless you have a dire liquidity needs, which anybody can have. So idea is to stay with business forever. If you believe that the DNA is changing, if you believe that the corporate governance is changing, market will give you enough time. Satyam happens once or twice. Not all 600 companies will be Satyam, right? If anybody tells us that DHFL was something which was not known, we don't buy that, right? Satyam was the one which was not known by many of the people, right? But that accident will happen if you're into the businesses. But rest, if you're really doing your homework well, right? And if you're investing into right businesses, obviously you're bound to make money, but as Siddhartha said, just look out for the bigger picture. Businesses go out 10, 20, 30 times. And if you have the right positioning sizing, you can really, really make money out of this. So that's what I want to really bring, because we are at the cusp of the market, but there's a lot of FOMO feeling. People think that a lot of people have made money and we are feeling, have left out, but that's not the case. People who have made money have been there in the market for 10, 15 years. That's the most important point. Right, Siddharth?
Absolutely. And if you look at even in the small caps, the first most important thing which one should figure out the size and position, etc. So automatically for your portfolio, don't have more than 15 to 17 names at any point in time in your portfolio. Whether it is a mix of small, large, or mid, does not matter. What generally people do, and this is a very important thing, please hear it carefully. What generally people do, they have good position where they're making money to the extent of 50% single position, and then they have a long tail. Long tail comprises of 100 stocks, 1%, 0.5%, and it keeps on going. And I'm not saying for a client who has for a person who has a portfolio of 5 crores or 50 crores, even for people who have 10 lakh of portfolio, you will see that 3 or 4 lakhs is in a large, in a single stock. And then you have 50,000, 20,000, 30,000, and nobody wants to exit anything. Now that's the biggest challenge which you should not do. First is, can you hear at least the quarterly transcript? Everything is now on YouTube. Everything is on YouTube. You can, and promoters, all the promoters, whether it is a small cap company, mid cap company, or a large cap company, they come, the promoters, the CEO, the CFO, the management comes and they talk about, and that's a 45-minute tour. You don't have to get into a threadbare into the Q&A. At least you hear the first 30 or 35 minutes of the transcript, and it is all audio. So you don't have to even read it or waste a lot of time. Just hear it. You will understand the confidence with which the management is speaking what lies in future. That's the first thing. Because remember, if I'm not sure what's there in front of me, I will try and give I would give answers which are not very, very convincing, and you will get to know about them. And we have a whole bunch of analysts who ask very, very tricky questions. So that's number one. Can you listen to 30 transcripts every quarter? The answer is no. Can you listen to maybe 14, 15 of them? Maybe yes. So try and trim it and cut down from the places where you have low conviction and get into the ones which are high conviction. That does not matter. That does not matter whether it is small, big, large position, but high conviction is the key. Build position on that. That's number one. Do not go beyond 10% in single position. Ideally, do not go 10%. Now that does not mean that if your 10% of the position becomes 50%, you should trim it down. Never cut the legs of your fastest horses. Never. When I'm saying 10%, it is the initial position, your money invested. Over a period of next 3, 5, 7, 10 years, and you guys are very, very young, you have next 40 years of investment life in front of you. In next 40 years, you will see in next 10 years, some of your businesses will become disproportionately big in holdings. Allow them to grow. Allow them to grow. Do not cut them. And even if you have to add in there, it's fine. If you're getting fresh money, add in there, it's fine. So that's number two. Number three, and the most important thing, anywhere, if you see one very important, very small thing, you will start seeing mostly in small caps or in mid caps, promoters saying, this business looks interesting for us and we want to invest in here. Not adjacent, not backward and forward integration, nowhere related. Please exit the stock without even thinking twice, irrespective whether you're making 30% loss or 500% profits. Just exit everything. In India, nearly 75 or 80% of the businesses die because of wrong capital allocation. Not because of the demand, lack of demand, not because of the lack of capital, not because of the crookedness of the management, not because of anything else, not because of the window dressing, crony capitalism, not. 75% of the businesses, and by the way, every year nearly 700, in a good year, 1,200 companies get added on the listed markets. In a bad year, nearly 200. Whilst the numbers of the listed companies have been in the range of 5,300 or between 5,000 to 5,500 for longer periods of time, which means equivalent die, equivalent get added. The reason is wrong capital allocation. Please, this is the biggest red flag, If the promoter starts saying, this thing looks interesting to us, and he has no expertise, no adjacencies, no backward integration, no forward integration, please get rid of that company immediately. That's all from my end.
Super point. I think that's an excellent way to put it. You know, a lot of us end up booking profits, quote unquote, in our winners because we think, "Arey, double ho gaya, 2.5, 3x ho gaya, ab aur kitna aage jayega?" And those end up becoming the 80xers and the 100xers in a 2-decade time span, which fortunately for us in our 20s and 30s, most of us alumni are having that 20-year horizon for our good stocks. So I'm going to ask one.
Sorry, Pranav, just add on. Relaxo was 4 crores market cap, 4 crores market cap in 2000. In 2020, in 20 years, it is only 20,500 crores. And we have enough examples, 4 crores to 20,500 crores. We have enough examples like this. So please do not cut the legs of your fastest horses. And you have a long runway, long runway. Remember, if you invest wisely, your next 3 generations don't have to work or invest wisely.
Perfect. So I'm going to throw a question which Vishal Goenka has asked. His question is, if we invest in a strong business, but we aren't at a point where the businesses may compound at 15-20% going forward, with PE multiples compressing, the return could be much lower. What factors can lead to a PE multiple compression for a company or an industry?
Okay, that's an interesting one. I will share my thoughts here. See, there's always 2 parts to the stock performance. One obviously is earning growth, and another one is P rating or D rating, right? And we have spent a lot of time and energy, since we are not doing the presentation here, but we could have easily pulled something out of on that. We believe P rating, D rating is definitely overrated, right? We have seen many such instances in the past where businesses has derated on multiples. Asian Paint is a classic example of that, right? If you look at from 2000 to 2010 and all, where the P derating happened, it happened in Page Industries also.
Sorry to interrupt, Aishwarya. Can you speak a little louder? Actually,
sorry. So what I'm saying is there are 2 parts to it, on the stock performance. One obviously is the earning side, and other being is the re-rating, which is both upside and downside, re-rating or de-rating. And what we are seeing right now in the current market, that more than earning, it is the re-rating which has led to such kind of a performances. But right, if you just remove the short term, we always believe that the re-rating and de-rating is always overplayed, right? We have seen many such instances where stock has seen de-rating, right? Asian Paint is a great example of that. But you have seen that earning compounding happens and compensate for that de-rating, and then you are bound to make, like, say, if the earning is compounding at 20% and you are seeing a 5% annual de-rating of those names, you're still making 14-15% on stock on an annual basis. And this we have seen in many such good companies over the period of time, right? So now, coming specifically to the questions where you believe that there are some businesses which are not able to justify the valuations, where the earnings are not expected to grow. So it basically means that they're not trading at 1-to-1 time PEG, they're trading at 3-time, 4-time PEG. There is a possibility that the de-rating can happen. You should possibly took money off the table from those kind of a name. But wherever you believe that, that as I said in the first question also, where you believe that earning resiliency is there, right? And if you believe that business has a strong standing, don't spend too much time on this re-rating, de-rating phenomena. Because see, we never know how things will play out. I told you the example of IT stocks, right? From 20 times, people have never seen it is at 30 times. Happiest Mind is at 45 times. And it can continue to, if you can see 30-40% earning growth for the next couple of years. Why can't the rating sustain at that level? Right? So the point is, instead of focusing too much on re-rating and de-rating, you should focus on how these businesses should grow. And if you have even a pinch of comfort that these businesses can do 15%, 20% consistent growth, stay with that name. This is what my only point here. Second thing, obviously we are standing at a market where we have seen a market pull, very strongly in a short period of time, thanks to liquidity, thanks to lower interest rate, thanks to whatever reason we can tell, right? But as Siddhartha said, be ready for the movement and the volatility. So I can tell you the most difficult thing in investment is not selecting the stock or buying the stock, right? Or taking the call. The most difficult thing in investment is to do nothing. Now, I can tell you, I think there was this study which was done that the best performing fund at Fidelity were people which for the clients was generated where the investor manager had done nothing. There's a lot of case studies like this, and you can see many of those people who have been buying stocks not spending too much time on macro, not spending too much time on geopolitical thing. As said, that it's all about EQ than IQ. The more you think about it, now it's become 30-time P boss. It's very expensive. I should take some money off, try to get that money, do it in some other, leave it for fund managers. They will find justification for all of this thing. If you are a genuine investor, stay with the course. Don't focus too much on re-rating until unless you see the stock is trading at 4-time, 5-time peg or some very crazy valuations, which happen in the cases like if it's a close firm, I would speak like say, which happened in the case of HEG. Right? It's good to take some money off, good to take some of your capital off, but that would be rare. So my point is very simple, that don't play this re-rating, de-rating card, because we never know. Nobody knows. What makes investment most simpler things to create wealth? Because see, all of the 70 people who are on this call right now, or the 7 lakh investors who are hustling their mind on the day, nobody knows where the market will be tomorrow. No one knows how the stock prices will move. That's the beauty of it. Right? So we're trying to portray things which is like trying to control the uncontrollable is a futile attempt. Isn't it, Siddharth?
100%. So I would suggest that's a very simple mantra which I believe works well, and I have seen it working well for last 20 years. A very simple mantra. There's a figure in the balance sheet, and you can get it on all the financial websites also. There's only one single figure which you should track: cash EPS. Cash EPS, if it remains within 5% up and down range year after year. So it should not move below 5 to 7%. Even 10% tolerance is fine. If that is the number which is consistent and growing, sirf cash EPS, that's all you have to do. No revenue, no EBITDA, no profit, no nothing. Cash EPS. It's a very CEPS number. Just look at that number. If that number is not falling, and even if it is constant, you are in to make serious money. But if it is falling gradually, and you will realize, please get out. Beyond 10%, and 1 year, do not worry. If it is 10% this year, then 10% and another year down, and you are seeing that the price is rising, then it is obviously something is amiss. And then just get rid of it. You are not here to analyze. You are not a forensic expert. You are a plain investor. Your job is simple: to make money. And how to make money in a simple manner. So only look at this single figure, cash EPS. As long as the cash EPS figure is growing, there should not be any challenge. Whether the Taliban takes over Afghanistan and Pakistan, whether US attacks full-fledged and reestablishes its control on Afghanistan, it really doesn't matter. It really doesn't matter.
Perfect. Makes a lot of sense. So another question we have from Ankit. Is there an example? You mentioned earlier that there is a wrong capital allocation is 75% of the company's reasons for delisting or sort of extinguishing and dying. Is there an example of this wrong capital allocation or any classic case study in the
100%. The first thing you should look at is Syntex Industries. The very, very famous example which I gave last time also, because it's dead and gone by, so I can use it freely. Anybody else will beat me up if I give them their names today. So think about it. The gentleman thought about the future, got the one. So it was Asia's largest plastic tank manufacturer, and is bankrupt. So it's all wrong capital allocation. They went into textiles. Why can't you just go into plastics? The only logical thing would have been if you can't even backward integrate, because plastic is a heavy industry. To set up a plastic unit by yourself, it takes a lot of money. So you were procuring, you were manufacturing, you were casting, and with no competition, you are doing the branding well. The biggest strength of yours was the distribution. You could have gone now to the villages and distributed. If you didn't want to do that, you could have just returned the money back in the form of dividends. Your market cap would have gone up significantly. You didn't do it. You went into the wrong capital allocation because of whatever reasons, and you are dead today. You are bankrupt today.
Cool. Raghav Bansal has a question that, so he's asked specifically on the Fed US Jackson Hole conference, but I'm going to make it more generic, that such large macroeconomic moves, especially by the US, EU zone, and of course our own Indian RBI, etc., how much of a bearing should they have on our decisions, short term, long term, etc.?
So Aishwarya, let me answer this. Then I would add, because I have a fundamental disconnect with this perception. People, everybody you hear on the street, liquidity is driving. Interest rates are about to rise. Inflation is rising. Three statements, true. Everybody is fearing. And the more educated you are, the more fearful you are, right? So if you're a 12th pass and investing into stocks, you are okay. As soon as you become a graduate, you are a little more uncomfortable. If you're a postgraduate in management, you are very, very uncomfortable. And if you are a fund manager or an analyst, you will tom-tom about it. Now let's hear the reality. Let's hear the reality, guys. First, the interest rates are low historically in India and worldwide. We all know this. 33% of the world markets have a negative yield. We all understand what is meant by negative yield. Only 30% of the bonds are trading between 0 and 5% yield. Rest of them are giving you negligible interest rates. Now, think about it. I will talk about the tapering as well. But let me first cover the interest rates or the liquidity part. Okay. So the first part is, if the interest rate goes high, who is the biggest borrower in this world? So we have a bond market which is closer to $123 trillion. The GDP of the total world together is $68 trillion. And the equity markets, all market caps put together, will be closer to $82-85 trillion. So debt markets are bigger than the equity markets. And who are the biggest borrowers? The governments, especially the Western world. Paschimi Sabhyata. So those guys are the biggest borrowers. And they are at the lowest cost. If they are the ones who are going to increase the interest rates, who will pay the interest more on their bonds? They themselves. It is imprudent to increase the interest rates, because if they do it, they are the ones who are going to pay the interest rate. And the trade-off is very simple. All the modern economic theory or all the modern economists say it's very simple. You borrow money at zero cost, push that money into the economy. The economy will flourish. As the economy will flourish, the taxes will be paid extra, and those taxes will be used to retire the debt. There is no problem. But this problem arises when the interest rate becomes higher, and when you have to pay the interest cost on the bonds which you have issued. The same challenge we are facing. The reason why petrol or the crude prices are high, because government is sucking out from us the oil bonds which were issued in the erstwhile regime. Instead of creating the provisions and the reserves, we are paying through our nose 100 rupees plus petrol cost, because our money is being used to pay off the principal. Forget the interest part as well. So that's the same challenge which the governments worldwide will face. So that's why governments will try and push the interest rates as much as possible. Now let's come to the inflation. Why is the inflation? Has the population of the Western world jumped significantly? Has the Western world seen any significant rise? No. The answer is why inflation is higher is because of the supply side constraints and the rise in the commodity prices, because the commodities which are being supplied from China has been curtailed because of the international trade challenges. That's a short-term phenomenon. It's not a demand side jump, it's a supply side constraint, because of which the inflation has moved up, which will get settled out in next 6, 8, 12 months. Every smart economist, every government official in the Western world and in India understands that. And that's why they are tolerant about the inflation which we are seeing today. That's number two. Second thing is, we all understand that internet economy has led to the disintermediation. Madhyamista. It means that people who were earlier supplying from the producers to the wholesalers to the retailers and to the end customers now are reaching directly to the end customer, which means that this entire value chain, the margins are either moving to the producer or to the consumer. Hence, the inflation automatically will fall in times to come. Internet economy or the internet distribution is going to ensure that the inflation reduces gradually worldwide. And that's why people are not concerned too much about inflation. Now let's talk about the third thing, tapering. Everybody is worried about tapering. I agree. As the economy will start heating up, as the economy will start seeing significant employment numbers, the buying of the toxic bonds by the central governments will reduce. How does that matter? It essentially means that the money supply which was extra coming in will get reduced. It will have a knee-jerk reaction on the liquidity, but will it impact the interest rates? The answer is no. Still, if people who are speculative in nature will borrow money, will take money from the emerging markets at lower cost and will invest into the emerging markets. So tapering may not have a significant longer term repercussion. It may have an impact of 1 day, 1 week, at best 15 days, not beyond that. Last point, which is the most important point. Till now, India was under a TINA factor. Now, Western world has come into a TINA factor. What does that mean? For the first time, the Western world is experiencing an inflation which is higher than beyond their tolerable limit. Which means that earlier, for last 20 years, the Western world had an inflation of between 1.8% to 2.2%. For the first time, they are seeing a number which is 3.5, inching up to 4.25. Income levels have not risen. Employments have gone up, not income levels in the West. Income levels are still the same, which means my savings are getting depleted because the inflation is rising, right? We all understand this basic concept. You are very, very smart people. I don't need to explain you this. What is my option? To take more risk to protect my money. Otherwise, my savings will get depleted. Hence, I have no choice but to invest into the emerging markets, taking higher amount of risk. That's why till the time inflation is higher, more and more retail foreign money is going to get into the country through the institutional route into the emerging markets. Last, whatever we saw in last 3 weeks from China, where the internet economy stocks have got corrected by 50%. The message is simple. What Afghanistan is for US, no US can enter into Afghanistan. Same way, no capitalist can enter now into China in terms of money. That's a simple signal. From where the growth will come. They still need emerging markets returns in the tune of double digits. From where the returns will come? Brazil is in a deep challenge. 1989 was the high when the Brazilian stock market, Bovespa, made a high, until now. It has not recovered from its highs. Turkey is in an authoritarian regime. We all know that. Russia is in a, I don't want to talk beyond, right? South Africa, we all know challenges there, unstable government. Which other emerging market, barring Indonesia, Malaysia, Taiwan, which other? And these are the smaller countries which do not have the capability to absorb such large quantums of money. Hence, India is the by default TINA factor. There is no alternative. Hence, for next foreseeable future, not only FDI, and it's not surprising that a $20 billion flow came into the country from unlisted space. It's not unprecedented. It is because there is no other alternative. And this is what is going to drive. India was languishing because India was capital starved. For the first time in the history of India, the capital in India is coming in plenty. Both hot money, both stable money. Both of it will lead its growth. To top it all, our retail participation, because of India's TINA factor, no real estate, no debt, no gold can give you those returns. Indian retail participation is all-time high at 80% when the volumes between 2009 and today have doubled. So between 2007, the last clear bull run. The daily volumes of delivery used to be 35,000 crores. Today, the daily volumes are 80,000 crores and still 80% participation from retail. Erstwhile, it used to be 35% participation. So if you are seeing, and by the way, if people have a challenge, FIs have been selling for last 3 months. Sensex or Nifty hasn't corrected. Hasn't corrected. Why? Retail support. Aishwarya, over to you, please.
Yeah, so I think you gave a very beautiful fundamental reason behind whether one should worry about tapering or interest rate hike and all that. We will not go on the cost of repeating, but I just want to share my experiences on this, right? There's one very important point which everybody should understand. Market has a way of discounting information. This is a very, very crucial thing which people doesn't focus on. When everybody talks about taper tantrum in 2013, 12-13, if you remember, market never tanked. People, there was no research on Google. We talked about financial crisis in 2007-8. It happened. Please remember, market never acts or fall twice for a same reason. If you and me, everybody's talking about tapering and the impact of it, some point of it is already getting discounted. I'm not saying the market can't fall 5-10%, it can do it. Market always find newer and newer reasons for it is action. First part. Second part is, obviously, if you're really worried about tapering and interest rate and all that, you have to see how India is standing. Like last time, our currency depreciated by almost a whooping 30% when tapering happened, right? It went from some 50, early 50s to almost late 65 or 68, right? That
60, 68, yeah, 68,
yes,
it hit a low, and 70 for very briefly, and then came to 68, and then Raghuram Rajan had to do the external foreign purchases, so he has to get the 5% dollar interest rates. Those were
like unprecedented times. Now we are sitting on more than $600 billion of reserves. Right, we are a country which is, as Siddhartha said, which has a different positioning, and which is about to show good earning growth and better corporate profitability. So our thesis is that market will digest all of it gradually. And then on interest rate, as Siddhartha said, we are in the camp that we can't afford. This world can't afford a high. We're entering into a structurally lower interest rate regime for ages now. Only time will tell, but we are very, very comfortable that interest rate will remain like this for unforeseeable future. I think I will stop here for any further questions.
No, excellent point. I think I completely agree that, and personally, I also feel that the current WhatsApp fueled, social media fueled information sharing lends to the higher need for what Aishwarya also said of doing nothing. Ki overflow aa raha hai or barraged with so much information readily in your hands 24/7. In from 20 word summaries to 20-page dossiers, that it's very easy to get tempted into going down a rabbit hole and thinking ki ye Jackson hole mein hi ghus jaunga main. But nobody, if you ask most people, nobody knew ki what Jackson hole was till 15 days before this.
Yes.
सुना नहीं होगा, लेकिन वो 20 साल से स्टॉक मार्केट में पैसा भी कमाया होगा और बच्चों का शादी भी किया होगा, बट है ना, अभी वो जैक्सन होल के बारे में सोच रहा है कि क्या होगा मेरे पोर्टफोलियो का. So I completely agree, it makes a lot of sense. Miyush has a question, Miyush Sharma, that as we mentioned earlier about earnings and sort of CEPS tracking as a metric to identify good companies or consistent businesses, how would we treat the internet or e-commerce businesses that necessarily don't make profit today, are in the listed space, so we can participate as retail investors? How do we take a view on their sort of expensiveness, quote unquote, or right time?
Aishwarya, you want to take it? Then I can brief, or
so you can start. I will give my input.
Okay. So very interesting question. So remember, guys, the first thing is, for any internet economy stock, the first thing is not about the revenues or the profit. generally, okay, so let me go from the very, very basics. The way to value a company is how. What do? You have a sales number, you have last 5 years sales number, or you have EBITDA number, last 5 years EBITDA number, you have the industry growth, you project next 3 years, next 5 years, next 10 years, you extrapolate it, then you take the weighted average cost of capital, take the NPV, and then that's the number which you get out of, right? Which essentially boils down to 5 times EBITDA or 4 times EBITDA, etc. That's or EV by EBITDA. That's the generic way. That's a generic way of valuing a company, right? Internet economy have 2-3 very peculiar things, and you have to understand this. Number one, in internet economy, stocks one time setup or the base business has large cost. Once that establishment is done, the marginal cost of new acquisition is almost negligible. Number two, in the internet economy, there are 4 or 5 stages of a customer. You start from a prospect, then he becomes a customer, then he becomes a affiliate, then he becomes an influencer, then he becomes a patron. These are the 5 stages of a customer in an internet economy. Now, as the client keeps moving different hierarchies in this space, automatically the incremental cost which the firm is incurring is not high, but the ripple effect which happens from an affiliate to an influencer, from influencer to a patron, keeps increasing the business. So that's number 2. Number 3, the potential market for an internet economy, a company like a Zomato, a company like an Amazon, is practically the entire India, the entire population. As long as you are able to do delivery, which means that the marginal setup is done, it does not matter whether it is 500 customers or 50,000 customers. And hence, the way to value any internet economy is to do reverse. First, you have to see the addressable market. What is the addressable market which this company which this entity can give opportunity to? What is the potential 5 or 7 year delivery volumes which one can see, or whatever matrix they are catering to? Multiply with that the revenues and the margins, and then see today, where do you head? Where are you? Then you have to take into account, to reach to that level, what is the differential in terms of the cost? In terms of the cost you need to incur if I need to reach there. And you will realize that the cost significantly underweighs the revenues which one gets into. And hence, today those businesses may not be profitable, but as long as the brand, as long as the delivery, as long as the credibility, which is again subjective, remains intact, there is a significant chance of these businesses reaching that milestone and becoming 10 baggers to 20 baggers over a next 5 to a 7 year time frame. That's number 1. So that's the way to value it. Number 2, what you should always look at it, unlike in traditional businesses which follow the simple cycle of early adoption, growth, peak, and then tapering off, internet businesses for finite period of time, which means next 10 years, next 20 years, next 25 years, can continue to surge at the same growth what they were growing at last 5 years or last 7 years. So the base effect, which generally happens in the traditional companies, may not kick in for the internet companies. So these are the 2 factors by which you should evaluate. The third thing, this is a generic thing and you should hear this. Today we are concerned that the market cap to GDP for India is 120, right? most of the Western world or erstwhile China had a market cap to GDP which was very, very large, significantly larger than 120. We were not concerned. Remember, the next leg of growth in the market cap of GDP will come from these internet businesses. So today you are getting perturbed of 120. Someday you will see in next 5 years, you will say 150 as well. Because most of the internet companies till now were in the backyard unlisted. They were still growing. They were still doing what they are doing today after getting listed. The only difference is they were not part of this market cap. So people who believe that this matrix, which has become very expensive, is not the case. Today we have only 3 or 4 listed companies which are on the internet. Matrimony.com, this Zomato, and a couple of them. That's about it. But there are at least 20 to 25 names which are going to get listed in next 12 months. And if you miss the bus, you will repent. So necessarily your 20% of your allocation, should be into this internet economy plays as a part of your portfolio. Aishwarya.
So I completely agree with this. I think we are close to 250 lakh crore market cap, right, Siddharth? If I look at from India perspective, correct. We see that if the number goes to 500 lakh crore, whatever increase will happen, at least what my thinking is 50% of it will come from new age businesses. That is what we believe. And I tell you one thing, we as a human being thinks on an arithmetic progression. We can't think on geometric progression. Technology leverage works on geometric progression. And what Siddhartha said, technology's cost of replication is 0. So you can't work with this number. My thesis is very simple. You have to have an exposure to new age businesses, tech-led, whatever way you are comfortable with. And as Siddhartha said, we will see many unicorns being listed over the next 3 to 5 years. There's a lot of time for everybody to prepare themselves. You have to think in altogether a new form. The conventional wisdom of investing probably will not work. Even guys like Warren had end up buying Apple at some point of time, right? We are nowhere. So get adjusted to this new reality of life, new reality of investment, and don't miss it out. I think there will be a lot of money which will be made over the next 5-10 years. Have a piece of it.
Great. So I completely agree on that view. And sometimes as the industry and the world is shifting, we need to shift as well, right? We can't remain in a 100-year-old investment thesis in the days of our great economists in the firm, because economics is not working the same way it did 100 years back. So Aditya Parikh has a question. Given the optimism for Indian markets, as we already discussed, what are the percentages? How do you suggest percentage allocation to index funds as compared to actively managed mutual funds? I'm going to sort of broaden this question into more of your thoughts, since you're talking about being our own fund manager. What kind of exposure should we take to indexes, knowing that it's easy, low cost, with a general trajectory to go up, versus more actively managed mutual funds, which could be theme-based or concept-based or something else?
So see, being a fund manager, I think I will be biased to speak on this. So I think Siddhartha should take this.
Okay. So I'll give a very honest opinion, guys. Remember, dump all the large cap mutual funds actively managed, dump all the mid cap actively managed, dump all the small cap you can retain, dump all the large and the mid cap actively managed funds, just buy junior Bs and index funds, and that too SBI, Nifty and Sensex ETF with an expense ratio of 0.08. Period. There is nothing beyond this. If you want to take exposure to and I would recommend that instead of taking a mutual fund, or you may be wanting to take a mutual fund because you are restricted if you're working in KPMG or Ernst & Young, and hence you can't have exposure to the direct stocks. So then you should get into the sector specific mutual fund. So you should get into the little bit of pharma, little bit of BFSI, little bit of FMCG. But remember, own plays which are secular. Don't buy commodities mutual fund. Don't buy infrastructure mutual fund. Don't buy cyclicals, please. That's not your job to time in and out. So 50% of your money, 50% of your money should be in the index funds. 40% should be in Sensex and Nifty split equally. 10% should be into the junior Bs or the mid-cap index. Rest $50 should be split across 3 or 4 sectors which are secular. Secular essentially means which constantly keep going up, or they have a positive trajectory, which includes BFSI, which includes pharma, which includes FMCG, consumption. Those. Do not try and enter into all these commodities or cyclical plays. Keep your life simple. 6-7 mutual funds at best. Bingo.
And keep your cost also low.
Correct.
that eats up your margin.
Correct.
And guys, Siddhartha, I will have to leave now. So
Sure.
I think Siddhartha will be able to carry it forward. Thank you so much, everyone.
It's already an hour, and we typically stick to an hour or so. So it's already over an hour. So I'm going to wrap up. Thank you, Siddharth, and thank you, Aishwarya. I think it was great. We had a lot more interactive session, and it was great to sort of have live questions from our audience, and look forward to having both of you maybe at a live event. We were sort of discussing last night amongst ourselves in the organizing committee that, it would be good to start live events sometime end of this year, and hope to have both of you join us, and Deepti as well. Thanks for coordinating all of this with us, and look forward to having you guys back with us, both online and offline, and we'll definitely share our feedback. Thank you so much.
Sure.
Thank you so much.
I will just leave with one simple thought, guys. Remember, we are on our way to become a $10 trillion economy, and within a period of next 10 to 12 years time frame, you can think where we stand today, what the economy will achieve, and if the economy will achieve, what the economic barometer will achieve. Thank you.
Thank you, everybody. Thanks.
Perfect. Thank you. Thanks to all the audience for taking a wonderful, for giving us your time on a Sunday morning. Have a great day and see you all. Thank you.